Well, to get us started, I appreciate everyone that's joined and you taking an interest to hear more about what we're building here at Nada. Um, maybe I'll preface it with, Nada's we've been operating for a little over 4 years now. Something that's been integral to us is 2.5, maybe 3 years ago now, we raised some investor capital from our community. We had a little over 3,000 people, friends, family, and new people that joined to invest in us. And it was incredibly rewarding to have that ability to have regular individuals invest in a startup. We've gone on to raise some institutional venture capital, but that that ability, that opportunity to bring in people that we can relate to invest alongside now, institutional investors is something that's very important to us. So yeah, that's really the reason that we're doing this and opening it up, and we just believe in building in the open and with everyone's kind of our community involvement. So thanks, guys. What I'm going to do is just use our investor presentation and walk through and try to be mindful of time, but I'm going to kind of riff on it. All right. So for anyone that doesn't have a sense as to what our core identity is, Nada is a real estate investment manager and an originator of an investment product. And everything that we're doing is built around this really new, amazing, emerging investment product that's called the home equity investment. Call it home equity investment agreement or contract, but it's this amazing new instrument. So on one side, we're asset managers. So we've created and we've obtained SEC qualification to release these investment funds that we call city funds, and I'll go more into this in a moment. But it's a really way that's very important to us. So we allow any individual to be able to invest in some of the top cities across the U.S. to get exposure to those like really high growth home equity markets. Now, at the same time, we originate this asset, so we're actually going to homeowners and making investments into their home and giving them cash, and then in exchange, we're creating an asset for their fund. So it's just really rewarding relationship on both sides of the market. On the right side here, we have some of our accomplishments and tractions thus far, but I think we can go in better detail in some of the subsequent slides. As you think about the market that we operate within, it's overwhelming. The U.S. residential real estate market today is $46-47 trillion in total market value. Now, of that market, 33 trillion of it is homeowner equity, which, said differently, it's the amount of the real estate market that is not encumbered by mortgage debt. So it's an absolute giant market that, if you just put it in contrast to the mortgage debt, that kind of that origination and just market size, that side of the market is 13 trillion. The equity portion of it's 33 trillion. So if you look at this from a homeowner standpoint, and hopefully some of you guys can identify with this, that is your largest asset. That is the greatest asset class in the world is residential real estate. But in particular, this is the greatest asset that a homeowner has. Yet it's incredibly illiquid. You can't access it unless you're going to take on more debt or you're going to move. So it's hard to actually make that meaningful, which is really core to our business and our purpose as to what we're doing. This side more represents just really what has it been historically in terms of the homeowner equity market size. You can see, historically it's always been a giant market, but more recently it has reached this very high market size where now there's far more equity in homes than there is outstanding debt, which creates an absolute opportunity to help homeowners unlock some of this trapped equity, while in our case, concurrently creating opportunity for investors to gain access to it, to build wealth and really diversify their investments. Taking this further and just framing it on both sides of the market, because Nada does sit in the middle. We serve two sides of a market around this home equity investment product. For a homeowner, this is a product that allows them to cash out a portion of their equity without the burden of debt. So there's no monthly payments, there's no interest rate associated with it. It is a true equity investment. Similar, it doesn't have any restrictions on how it can be used. So the homeowner can take cash out to invest in solar, to make an investment into a new business, to pay for the kids' school, really whatever they're going to do with it. There's also no limitation on age, which you might think could be related to like a reverse mortgage, which could be restrictive. And one of the things that's most important to us is it does enable the homeowner to retain ownership. So they are the owner of the property. And not only do they continue ownership, but they also have still, because they have majority ownership, the equity upside is still retained with them. So as a homeowner, it's, we're really partnering into their home as an investment to share in the upside, and we're gaining that alignment when we bring it to the investor side. When you take this instrument and you look at it for an investor, the very first and maybe the biggest thing is it allows for an individual investor or institutional investor, any investor, to gain access to a historically untapped market, and that is the owner-occupied equity portion of U.S. residential real estate. And if you put this instrument out up against like a single-family rental property, if we were to build you build a big fund on a bunch of single-family rentals, there is a lot of management and responsibility that goes into that asset. As a fund manager, you would be responsible for the condition of the property, the placement of a tenant in the property, the collection of payments. And so you have a lot of work and effort that goes into maintaining that asset beyond just the collateral value. In the case of this instrument as an asset, you don't have that, because the owners, again, are retaining ownership and equity upside. So in effect, it's a self-managed, highly efficient asset, and also one that requires far less capital to get a diversified exposure to any given market, because we're not buying the entire home, we're investing in fractions of homes. And the return profile of this investment is very, very strong. And that's a give and take, to where the benefit to a homeowner to get cash out of their equity today is of high value. And so the equity return on that, it's still a benefit to the homeowner to come in at a higher return rate, so that you can have downside protected and really strong return profiles for investors to come into it. And I guess I'd be remiss if I didn't express this last piece. The origination and construct of the instrument is incredibly similar to that of a home equity line of credit or home equity loan, in how it's originated, and that it is secured by a lien and collateralized by a mortgage or a deed. So you have direct connection to the underlying real estate asset. Now, this is where some of the uniqueness comes in for us, and how our model works. We've created an ecosystem that allows us to match investors with homeowners. So when you think about the Nada platform, we are an investment company that's issuing these city funds available to individuals to come and invest in. So when investor capital comes into a city fund, which could be Austin City Fund, Dallas City Fund, et cetera, the capital is then pulled to be deployed into a diverse basket of assets. So it's a REIT construct that's pulling investor capital into these vehicles, and then that money from investors is what we're using to go fund the originations to homeowners, whereby the homeowners are getting the upfront cash, and in exchange we're getting this lien secured investment into their home. So now we've taken the capital in from an investor, put it to work in a home to give the homeowner the benefit of cash. Now we've got an asset. Now the agreements have payoff triggers, and when the homeowner is to pay off the home equity investment, typically when they're selling their home, is the mechanism that's generating the payment. That payoff is then returned to city funds, and so the gain on the repayment is dispersed to our investors as a gain, a dividend, and then the principal that's returned is immediately recycled into originating a brand new home equity investment. So that way it creates this recurring cycle of, we're always originating new assets, we're always recycling capital to consistently grow AUM. It helps more homeowners, and it ultimately generates better return profile for our investors on the platform. Walking through a bit more of what our City Funds product is. City Funds we designed to be really index ETF-like exposure to a single city's housing market. And so each city fund is individual, they're not cross-collateralized. So we have Miami City Fund, and these are series LLCs. So Miami would be Miami Series of City Funds 1. That way it's individual and it's efficient as such. That city fund pulls capital for the purpose of investing in these fractional home equity investments within the greater metro of Miami. So what that enables is a highly diversified basket of real estate assets. Really unique way of getting direct exposure to the economic growth and movement of a certain city, because you're right there with homeowners. And the design, again, these funds, they're evergreen, so they're open-ended funds that are very much appreciation driven. Net asset value, share price is the key component that goes into it. so that they're always building, they're always, perpetually, we intend to be originating new assets and growing in AUM, and investors benefit from that. Actually, I think this slide is a little bit outdated. We have 8 active city funds today because we just released the Houston City Fund, I think yesterday. And we have 5 more still planned for this year. So we're consistently launching more cities and more unique ways to invest in this asset class, that being the home equity investment, HEI asset. Let's talk about traction a little bit. Whenever we went out to take this product from city funds, that is, we first created city funds via a partnership and joint venture with a company called Republic. Republic is a private company investment platform where startups can raise capital on their they raise capital for crypto backed assets, real estate, all kinds of things. It's an amazing company. So we actually initially started it there, and then we took the product over entirely. Now it's for some time been ours, but we had to go to the SEC and FINRA to get qualification to become a direct issuer, to where we could sell investment securities to effectively the public from our site. And that process started in late 2021, and the final qualification came in October of 2022. So October 2022, NADA becomes SEC qualified to offer the city funds direct to investors. And when you think about the traction for us and what we feel proud about, if you look at the first quarter of 2023 is when we were really trying to get the product off the ground. We did just at $290,000 was invested on the platform, which we were proud of. We went to market a brand new application, a pretty high hurdle of presenting, what is this investment product? Why do I want it? Why am I going to give you all my information to do this? But then we really dug in over the year, and we found very scalable and strategic partners to help us promote and grow the funds. And so we ended the year, the last quarter, Q4, we did almost 2.3 million in new investor contributions coming into the funds. One of the things that we find is a very positive signals that our community, our investors like these products, is that really for the last 8 months, around 60% of the new investor capital contributed on platform is coming in from repeat investors. So not just net new. So we think that's a strong signal that people are liking the product and that there is demand for it on the investor side. And it's something that we intend to, as we're doing here today, to scale it, take more capital, bring on more partners to reach a much larger audience with our investment products. So perhaps a directly related reason for this would be how the funds performed. We're very happy with the performance so far. We actually started this with a little bit of a market, maybe you could say some of a cliff that was coming down, and these markets have stabilized a bit. But in the nature of the contracts that we're putting in these homes, there's such downside protection that even in some of the declines, we still have substantial appreciation. So on this slide, you're going to see the individual cities, and then to the right, what's the appreciation since since launch and when we started updating the net asset value per fund. So the funds across the board are really tracking at an annualized return rate of anywhere from 16 to low 20s across the funds we have today, which is really where we set the targets. We expected these funds to generate, over a longer term period, around 18% IRRs, and it's 2 to 2.5 multiple on invested capital. And we're seeing that actually start to happen here now that we've had some maturation and we've realized some payoffs of some of these home equity investments, but mainly that we track the appreciation of the assets that are held in each fund. Let's see. So now when we say on the homeowner side, how much of the home equity market have we unlocked, and what does that customer look like? Kind of how, what does the asset and homeowner supply side look like coming into this? As of February, we've unlocked just over 10 million of home equity, and there's a delta there in how much equity we've unlocked versus how much capital is on platform. And it's because we have taken on some debt to help leverage and originate more of the home equity product. We too absolutely have more homeowner side demand today to unlock equity in their home than we currently do capital to match it. And I think this is a good one, Sundance, to let me kind of pause before I lose my voice and have you just kind of walk through what's the pipeline like, our customer like, and what's the future of that look like.
Sure. We are originating currently about $3 million worth of home shares on a monthly basis right now. we have this slide is actually posted in January. As of what's today, March 8th, we actually have a $12 million wait list. And most of that coming from our partners in the home improvement industry. For anybody in here today on March 8th, if you're watching this on the replay, you could probably still Google search it. But the press release was put out today that announced our partnership with a large solar company with progress to go nationwide. We have been piloting a program with them for now 4.5, maybe 5 months, and the majority of our business over that time frame has come from our partnership with the solar company and other home improvement companies. Our FICO scores have actually risen quite a bit. Early on in our our testing phase, we worked with a cash out type of model for folks doing debt consolidation with lower FICO scores. We have found that the profile of the homeowner for home improvement has just a better return. Our average age is somewhere in the neighborhood of 48. Our average homeowner life, they've been in their home for more than 5 years now, and they've got significant equity built up in their house. With the current interest rates in the current market, homeowners are opting to improve their dwelling rather than upsize or downsize their actual property. So they're reinvesting into their property. On the investor side, our investors really like that, John, because the capital is deployed immediately and the asset valuation is up. And from the not a parent company side, we have an origination fee every time there's a transaction. Every one of these that we originate, the not a parent company, we make our origination charges there. That HEI amount, 53K, is actually on the uptrend as well. Home improvements are closer to 75K. And so some of those demographics and those KPIs are actually trending in the right direction for larger volume numbers. Hence the $12 million we've got on the waiting list right now.
Yeah, that's great. Thank you. Yeah. Another thing that's going to drive that up is we're now originating in Colorado, or we started originating in California. So when you start adjusting home market values to match with state and geographic footprint, you're going to see that. But the headline here is the demand for people that are taking cash out of their home to reinvest back into it to increase the collateral value is so high that that's the core customer that we're focused on, and it provides a homeowner good, but also a very attractive asset to our investors. All right, let's see what we got next here. So how do we make money? We make money throughout the entire life cycle of this home equity investment product. Now, to what Sundance is referring to, we originate these home equity investments with homeowners. And for those of you that have a home or have dealt in the mortgage space, it is incredibly similar to that same process of how you were to get a mortgage, or more so like a cash out refinance or even a home equity line of credit. That is the process. Sundance and his team, our entire origination team, are licensed mortgage originators, and that's how we sell this with homeowners. But when the homeowner is getting cash, like let's say the last example is $53,000 is the average they're getting, then we're collecting an origination fee and a processing fee out of that cash that's going to them. So it's just being deducted from that cash that's being sent to them via escrow, and that's how we're getting that money, and that's immediate on the deployment of and closing of a deal. Again, those of you familiar with the mortgage product, it's very commonplace. On the asset management side, where we put our city funds hat on and we're managing that, we then have matched the capital sitting in a fund ready to buy this asset. So we have an asset acquisition or sourcing fee that's attached to the home equity investment as well. Now, for the sake of presenting this to anyone that's looking to invest in NADA and how we make money, it's easier to display this as a percentage fee. So if we go originate a home equity investment for $100, and then we want to sell it to a city fund, then we're going to sell it to a city fund for $105 or $107, and that's how that money is exchanged. But in reality, the market value of that asset that we paid $100 for is around 120 to 130. So it's technically still selling at a discount when you put the mark-to-market value of the asset. Maybe it's a little bit in the weeds, but that's the way it works, to where the economics and appreciation is not lost in that transaction. Now, when money goes into city funds and then an asset goes into to appreciate the value of that capital, that's how AUM, assets under management, continues to grow. And then we, as fund managers, generate a recurring revenue of 2% assets under management fee that's accrued on a monthly basis and paid to us quarterly. So we have this component of really a recurring revenue model and some direct recurring revenue that's built around these evergreen funds that enable us to manufacture more of these amazing home equity investments. Add some context here on our revenue. I said earlier, we've been a company that's been working for a little over 4 years at this. We started initially wanting to create new financial products in ways that homeowners could have more of a relationship and better monetize their real estate to keep more of their wealth that's being lost in the transaction, and to have more information and understanding while they're in it. Like, how can you get more value out of it? What is this, really treated as, again, a relationship around an asset instead of these very disjointed life event transactions. And for the first few years, we weren't able to really get a home equity investment type product to market. It was something we've always wanted, but our core business was mainly focused on, can we help someone by being vertically integrated, whereby we can help you with real estate, mortgage, title work, et cetera, where you save more money on the transaction. And that's what we did for some time while we were building up the City Funds concept and getting everything in order to create a capital source to make more of these home equity investments. So when we say we did a pivot, it is that when we raised our price seed round, excuse me, in June of 2022, we did it specifically off the business model of, we realize now the best impact we can make for homeowners and everyone that wants to gain from real estate is to focus on the growth of the City Funds investment product and the origination of these home equity investments. And so in effect, we burned the boats. We had no time, no money spent or anything to build out business on traditional real estate or mortgage. And we forced ourselves to build revenue sources up from these now core revenue channels. And so that's exactly what you're seeing here. Q1, Q4, a 3x growth in revenue. The big thing behind this is the quality of the revenue. The revenue that we're generating on this product is consistently holding at 90% gross margins. So there's very little cost associated with it. And the profitability we can generate off of this product and this model where we're self-funding is such that we've now have 8 consecutive months of contribution profitability. So it's very high quality revenue. And now that we've established these core product market fits on both the homeowner side and investor side, we're in a position to scale the model. We're coming out of the testing, this works, that works, and now let's really go nationwide. That's why you see the big jumps as to how we could achieve revenues this year of 4.4 and then get to 25 million in 2025. I think we're incredibly proud of the product that we've built. The product team we have is amazing. We're lucky to have them. But this can be a very simple product. It can be a very complicated product. It's all about how you present it. We like to think we're doing a pretty good job of presenting it to our investors, where you understand what it is. It's simple enough to get started, but then transparent enough to tell you the full story. So we're very proud of the application we've built. It's available on the web. It's available in Apple iOS and Android, the Google Store. The other thing is if you look at this asset type and how you originate it and the investment products, you could say it's a bit of a Wild West as to how you can approach it. I myself and Sundance in particular, we come from mortgage backgrounds, very compliance heavy industry. It's what we know. We've learned how to navigate that. And so we've built everything here with that in mind. So we have robust qualifications and licensings under the investment side with the SEC and FINRA registration, which is built in. Our financials are audited on an annual basis, publicly filed. And then everything we originate is in a state that we carry an origination license for mortgage. We use mortgage compliance systems. And the key point I'm making here, everyone, is that we've built it very early on to be long-term sustainable. As new regulations come in or anything could restrict it, we've gone above and beyond to be perhaps more compliant than otherwise is being asked to be, because we see that being the future of the scalability of this model. I'll pause and just kind of zoom out on this. We spent the last year in the seed capital that we raised establishing core partners to source homeowners. We've built out the ability to manufacture, to originate. We've got subservicing relationships. So we've got this whole end-to-end way of like, how do you make this asset? And then we've built out the ability to sell the investments, to engage with investors, to publish updates, to show appreciation. We've built the model. And the reason we're raising a little bit of capital right now is because through a series of conversations with our board, which is comprised of some of our venture investors, such as VM Ventures and Liveoak Ventures, as well as a couple of really experienced operators that I have great admiration of, we feel that the market in our positioning is ready to raise a growth round, a Series A round of investment, which would be a larger round. And we thought to take on a little bit of capital ahead of that to better capitalize the company so that we can put a little bit more money into some of the marketing channels we have for our investor acquisition to show how it could scale, that we can go deep with these partners and the cost is not diluted. You know, it's economical. As well as we now have a few term sheets from institutional lenders that are willing to come on top and take the home equity investment asset and give us some credit. And this, again, is most like how you would think of a mortgage origination, so where you could take in a higher credit line to originate more assets than your equity capital can afford, so that we can make more and we can more thoughtfully scale and grow our AUM and origination volume. So to stand up a facility like that, there's a little bit of legal work needs to go to structuring the entities, the borrowing base, and the construct. And then there's a certain amount of capital that needs to go into it to back it and just really stabilize that facility. So the intent of this capital we're raising right now is just to backstop and fund these efforts, which we believe will set us up to have a valuation in terms for a Series A later this year that we can all be proud of. That's the intention. But this specifically says, okay, what have we done on investor acquisition? And then what do we intend to do from this capital? This is our use of proceeds that's broken down into three core buckets. You know, do we have access to investors? Do investors want our product? We've got historical proof points of yes, we feel confident with it. Okay, so what are we doing to accelerate that? You see that on the right, and what it's expected to return. The other thing you'd want to say, okay, well, do homeowners even want this thing? Do they understand it? Do they want it? Yes, in abundance. We've demonstrated that. But now we need to actually start funding this pipeline. We have 3 million. How do we get to that? How do we even chip away at this? What was it? That's 12 million in wait list. Well, that's going to be where we take on. We add in some institutional capital partners that could come in and give us 20 to 25 million of extra capital to put to work near immediate. And so that is what we're going to do to backstop these partners in this homeowner demand. And so that's your homeowner capital markets investor strategy. And it's really the core pillars that helps us take this business from where we're at today to the next position to get us closer to a much higher growth. The quality of the revenue in the model we have is designed as such that we can reach a 100 million annualized revenue and in profitability in doing so. An argument can be made we can make it by 2026, but it's going to be about smart deployment of capital and pace of growth. But it's something that's absolutely within reach. And when you zoom out and you think, okay, the ability to raise capital for our funds and grow them is going to create this this ability to recycle higher volumes of capital, so where we can continue to build on that as a compound effect. And that's really the core, piece of criticality to how we can reach scale. Let me pause and say something. I want to make sure you guys know we recently added Tor Steen to our board of directors. And Tor was a co-founder and CEO of an investment platform called CrowdStreet. Above that, he's an amazing person that we're very glad to have on board. But in that role, he built one of the largest online investment platforms for commercial real estate. And so he built that from a great idea to over 4.2 billion has been invested on that platform from individuals. So we're able to gain quite a tremendous amount of lessons learned and network and partners and everything that's going to help us grow and accelerate the growth of our fund vehicles. So that's one key thing here internally, very, very specific to us, that really helps us to accelerate growth. Now, when you zoom out on this home equity investment product, it is also having a bit of an inflection point from an investment banking kind of capital markets. We are actively, I would say, one of 5 companies that originates this product. And there's some distinctions between how the other ones originate and how we do. But for the sake of just really sizing, let's say we're all doing the same thing. What you need to be an originator here is capital. We clearly have created city funds to manufacture our own capital to create this product. But what has started to happen is there's been recently 2 rating agencies have come in to rate this asset for our securitization. And that opens up certain capital efficiencies that have existed for a long time in the mortgage market, for example. And so any mortgage company that's going out and originating a 30-year mortgage is not expecting to put all their capital locked up into a product for 30 years and to sit back and wait. There's an ability to sell that and keep moving capital to make more, because there is a structured secondary market. And we're seeing that form with the home equity investment product right now. So this is just happening. We're in the conversations with, in particular, KBRA is a rating agency that we're engaged with. And as that market gets more formed, we now see a way to where if a city fund, or call it the family of city funds, is sitting on, say, 500 million of home equity assets under management, and we at some point want to exit some of those via securitization, we now know that the valuation of that exit would be very beneficial for our city fund investors. It comes in at a mark to market, so it's a really good way to sell them, and it helps us really manage how fast and when we're paying off, in effect, these home equity investments, generating returns, and then creating new ones, generating returns, creating new ones. And so it creates this massive recurring revenue model that we can really control as the secondary market is forming. The size of the market is incredible. To get to 100 million, you run through the model like this. Basically, this slide is telling you what has to be true for us to get to an annualized 100 million in revenue. And the AUM on platform is 0.005% of this massive market. We're more aggressive. We're competitive by nature. We want to help more. We want to get larger share of that. But this is just that reality. So the absolute magnitude of the market that we're operating within. I thought this would be good information for you guys to share, and I recommend, as I go into this, that you go check out these independent platforms. But there's, I guess, coming from our world mortgage, you think like someone could say their home is worth $500,000. That's good and well, but you want to get an independent appraiser come and say like, what's the actual value of this home? And it's not someone that's biased that's in the home. So if you're looking for something similar to say like, okay, do I think not as a good investment? Of course I do. I put everything into it. I believe in it. I'm here every day. Sundance is the same. Sundance first even joined us as an investor himself. So we're going to think that. But you can look at, there are public records that do an analysis of what is the, what is the quality of this investment. Perhaps the largest private platform would be PitchBook. PitchBook has a venture capital exit predictor, and they've informed us that our opportunity score is a 94 out of 100 on their platform. So that means they've analyzed, I think it's around 70,000 venture-backed companies, and what they're presenting here in their own is that they are presuming that we can generate a return greater than 94% of the rest of that analyzed cohort based on the current terms or raising capital on the stage of the company, and ultimately what is the potential upside of what not is. And then very similarly, there's this platform Kingscrowd, which does an analysis of private companies that are listing and offering to the public, and how do they rate it? What is their rating system? And as you can see here, guys, they rated our investment opportunity rather as a 4.8 out of 5. And again, recommend you go to Kingscrowd, you go to PitchBook, you dig in to see what this means, what it is. But just to give you some color as to someone else's assignment as what is the potential upside and opportunity that's presented with what we're building here. This is a snapshot of some of the team. I like to say it should be everybody. Great ideas are great. Operating in big markets is great, but it is all about people. And we have, the luxury of having amazing people that are fully committed. I feel like everyone has an ownership mentality to a point it's almost scary sometimes from my role because I'm so accountable to them. Our team is amazing. We have a ton of background in related fields and a lot of complementary areas as well. A lot of diverse voices, and everyone's critical to building this. I think I touched on this. The board, our board is critical. It's I report to the board. We have Krishna, who is a founding manager partner at Live Oak Ventures, a large institutional venture fund that led our seed round, and also of note is the lead investor in this current investment round, which is the opportunity that you guys have to co-invest alongside. And you see Tor from CrowdStreet's on our board. Vikram was our angel investor, amazing friend and mentor. Built a big mortgage tech company, Capsilon, sold it to another mortgage tech company called Ellie Mae. So anyone on here that's got the mortgage experience would probably relate to those names. But great individual, great voice on our board. A very good friend of mine, Jesse Stein, was founder of one of the first fractionalized investment platforms that went to market, a company called Compound that was ultimately acquired by Republic. That's where I got to meet him. He's joined our board, and he's gone on to create a very new, very interesting new company, Everrealm, in the kind of crypto blockchain space that I still feel like an old man that I don't fully know how to articulate. Sundance, I want to like maybe turn it over to you real quick to see if there's anything you wanted to end with or keep me on point with. Sundance, can you hear me?
We do have a few
Hey,
questions. I lost audio, partial audio, so forgive me if my if it sounds a little off. We do have a few questions. A couple of them I can answer, John, and then I'm going to throw a
okay.
couple of questions to you. First question that came across is actually a question about Republic. So we have some investors from Republic here. Republic recently announced a partnership with Stake. Does that impact our business model at all? It doesn't really. So Stake is actually a real estate investment group that specializes in Middle East investments. It's great to see that Republic is encouraging real estate activities on the platform, but doesn't have any direct impact to us. Another question that came up was how does market volatility impact the Nada business? And this is really an interesting question. This comes up all the time because people are concerned. They see it, news wise, interest rates go up, interest rates go down, housing prices have stagnated. Will housing prices go down? Will they go up? And it's important to remember that Nada actually is not directly investing in these assets. We are the platform that facilitates the exchange between investors and homeowners. We originate the transaction, and we have investors who purchase that, and they make the decision. In some cases, people invest in both, but they make the decision on when to purchase. Some people argue that it's a good time to buy right now because if interest rates fall, home prices will go up. But Nada, the platform, makes money transactionally when we combine those two parties. So that $12 million that we saw on the waiting list represents, if you did the math there between the origination fees and the selling fees, roughly $1.2 million in revenue that comes into Nada. And we like market volatility. We like the trend, whether or not it's going up or going down, because if interest rates are going up, our product, our home shares product is very attractive. If interest rates go down, it means home valuations are going up and the investor side is very interested. And we target in large parts a insulated product. So we can partner with home improvement folks. We can partner with debt consolidation folks. We have a lot of opportunities to grow, including like a mini reverse mortgage type of a scenario as well. So whatever the market throws at us, we like the trend. Volatility is our friend in this business. So the trend is our friend in this particular case. Those questions I was comfortable answering. John, hopefully you can answer this one that comes up next.
Okay.
Is Nada's plan to provide a platform for trading for secondary investments for city funds? And does that not help the business? Does it take money away? I think is the question from new money coming in.
Okay, that's a great question. The answer directly is yes. We do intend to enable trading. We have a partnership with an SEC registered alternative trading system that's operated by North Capital, a broker dealer, and many other things they offer. So we already have that in place. It's structured within our offering that we've got qualified with the SEC. For us, in order to activate an on-platform private, it's a bid-ask system. We believe it's in the best interest of our investors to continue growing volume of individual investors on platform, and allow the funds to mature a bit before we activate that. So there isn't this sense of I'm trying to sell something and there's not enough demand for new. So it's a bit of building into it. So we have the functionality there, but in order to make it most effective for our investors, we don't see that to be something that should be activated in the very, very near term. And to put a timeline on that, it's something that we intend to have Q4 to Q1 of next year. Many things could accelerate that. And it's so much into how we communicate. I mean, if you look at investing in real estate historically, just owning real estate, you should view it as a long-term investment. Our model is to provide liquidity and liquidity options much faster than typical. So a typical private real estate investment has a lockup period, meaning no liquidity, no way out for 10 years, maybe at best 5. That's not our belief and not how we've designed it. So we're much faster than that. But you should hold it for a while and you should view it as such when you come into it to really make the most of your investment. But the direct answer is yes. And I'll go back to, and I get that it's definitely in the weeds, and I'm an in the weeds guy. So sorry about that. But when you think about the growth of our funds and the ability to liquidate assets through securitization markets and how that's forming, then there's a certain point where we grow a new money coming in, and we can recycle assets via securitization to where current investors are getting, again, returns on that. We're far less dependent on new capital coming in to make more assets. And it would be a business move for us to actually activate and be the broker dealer behind trading on platform to keep the price low, but also create some revenue sources for us. So it actually aligns with our vision and opportunity, just at the right time.
I've got probably time for one more question here, and this is a good one. So we've talked a lot today about how Nada generates revenue from, the transactions, the investor side, the platform, the home share side, the originations. The question now is, okay, as an investor in Nada, for somebody who is maybe new to the types of campaigns posted on Republic or WeFunder, what is the exit strategy? What is the end game? How does somebody who invests in Nada, how do they realize gains? What's that, just broadly speaking, what's that process look like?
Yeah, that's a good question. It's, I would say it's probably something that startups such as ourselves don't talk about too often, um, because you don't want to set weird expectations when you're early stage. But there's some truth to, like, why are we doing this? Why are we building it? Why did an institutional, investor invest in us? Like, what are they trying to get out of it? And so it is a high return profile. And if you look at like a real estate investment, you should always know what you're expected to get out of it. And I guess that's the common way to do it. When you look at where Nada could go and how you get a return on your investment when you invest early, it is through two things. Either an acquisition where a company comes in and buys us, and that will have an actual cash event, and then whatever your interest is and the value of the company that acquisition is how your payout is. Or the company builds to a point of an IPO, which is a similar cash event. We like to think that if you were to look at a couple of market comps as to what's an acquisition, reference point as to what we think could be a good acquisition for us, we like to say like iShares. iShares was it was a BlackRock acquisition. They acquired iShares as this really novel new investment product, and the acquisition there was $15 billion, so it's a very big number. But we think the attractiveness at scale of our city funds product reaches a ton of interest. So there's an example of an acquisition transaction. Now, if you look at an IPO, you could say there's some similarities to SoFi and how they built a banking platform very specialized over a certain customer and an entry point. SoFi's IPO was 8.6 billion. Or you could look at like Lending Club. They had a very different platform and approach. Their IPO was right at $5.5 billion. So these are just some color as to where, as a company matures, like what could be the market valuation whenever an exit event occurs. It's very high. We're doing this because we believe we can impact the lives of many people in America, not just a few. And we're not doing it to simply try to generate lifestyle revenue or just to grind ourselves to death because we think it's cool. It is absolutely that we believe this can scale and should reach as many people as possible. And the economic outcome of that is 5 billion plus. That is just the trajectory that's on. When you think about the vision of our products, we believe that we can build relationships around homeowners by accessing their equity. Not too different than how you would think today you can move money from a savings account into a checking account. We fundamentally believe this is your wealth, your asset. You should have access to it. So there's some really cool stuff we're working on with Visa around a debit card product to back that. It's a ways out, but just to put some meaning behind how we see that mass distribution of this equity unlocked to homeowners. And then from our funds, they're designed to be IPO'd. So we would want anyone to open the Robinhood app or the Fidelity app, whatever they're investing in. And if you wanted to invest in real estate, you have the access to go pick Austin City Fund, Detroit City Fund, et cetera, et cetera. And so in both cases, we believe we can reach mass audiences, and that's our intent. And the exit opportunities, I can point you to them. Probably over on time, right?
We posted some contact information in the overall chat, so you can check out the WeFunder landing page. It has lots of information there, details, financials, some of the same graphics that you saw here. You can also reach out to us directly, hello at nada.co, and John and I are both on that email chain, so we can answer those directly for you. And I appreciate all the folks who popped in today to watch the video, and we will record this and send this out as well.